So let's start off. I'm just going to share my screen. So we're going to start off, as we always do, with this scripture that, if you remember last week, I did say we think that this is the scripture that underpins all our financial capability workshops. And this comes from Ecclesiastes 7, verse 12. And it says, "For the protection of wisdom is like the protection of money, and the advantage of knowledge is that it preserves the life of him who has it." And I'm just going to recap for us all, and new for those that haven't been with us before. What we're discussing is financial resilience, and financial resilience has been formally defined as the ability to withstand and recover from temporary financial hardship and disruptions. And it isn't a reaction response to an acute need, but it is a long-term, ongoing and sustainable process. It isn't something that, it's something that you plan for and you have ongoing all the time. And you'll remember last week I did say that the reason why it's of particular importance now, and certainly of particular importance for us and our members, is because of the focus that COVID-19 has put on the need for us all to be financially resilient. Well, I mean, it's an important need anyway, but COVID-19 has just exacerbated that need. And what we're doing this week is, we have here the 5 main elements of financial resilience that I went through last week. Last week, we focused on the most important and overarching element, which is wisdom in managing your financial affairs. And today we are going to focus on that element, which is the ability to borrow and pay down debt. So that's the main focus today. And I'm just now going to hand over to Shane, who is going to introduce the poll.
Okay, good evening, everyone. So the poll for this evening is, so you want to live a debt-free life. Is this possible?
So we'll give you a few minutes to respond to the poll. You'll see you've got 4 multiple choice possible answers. One is no, it's not feasible. The second is only when the mortgage is paid off. The third is only when I have a good bank of savings, so I have no need to borrow. And the final one is yes, it's possible to live your entire life without debt. So just a few minutes to respond to that. What do you think? Should we have the results of the poll? What's the poll saying, Shane?
The result so far with 47% is yes, it is possible to live your entire life without debt. Then the second response with 28% is yes, it is possible, but only when the mortgage is paid off. And then the third most popular response with 19% is yes, but only when I have a good bank of savings, so I have no need to borrow. And finally, the least popular response with 6% is no, it is not feasible.
So we have 4 responses. The most popular is, what was the most popular, Shane? Sorry.
Yes, it is possible.
Yes, it is possible. Actually, yeah. This is all very interesting when we're putting together, because actually all of those responses are right, depending on the circumstances, actually. And the most popular response, which says, yes, it is possible. Well, you see, the thing is, if you're paying, when you pay utilities and you're paying your gas and your electricity, actually, that is debt. And it's debt until you pay the bill, actually. So, and that's the reason why your utilities, you'll find that your utilities appear on your credit report, and it appears on your credit report, but it's because it is considered credit and is considered debt. So actually, if you're thinking really kind of strictly and purely speaking, it's not really possible, because you always owe somebody something. But if you set aside the utilities, it's really interesting about where you said, so 47% said, yes, it's possible to live an entirely debt-free life, all of your life. And I find that really interesting because most of us may aspire to do things like own a home, or have some other ambitious dream or vision, such as have a business even. And if you're going to do something like that, and we definitely encourage people to do have home ownership, it means immediately that you're in debt. And it means immediately, if you have a mortgage, that you're going to have a debt for 25 years. And unless you really have hundreds of thousands of pounds in cash, actually, it's not really possible to live an entirely debt-free life without, without actually that kind of bank of savings. So yes, it's entirely possible to live an entirely debt-free life. I think if you have all your life, your entire life, if you have lots and lots and lots of money to do it. For most of us, actually, we do need to spend some of our years, particularly our early and middle years, in some form of debt, mortgages, and various things like that, until we are sometimes older and we've paid off the mortgage, and we've also built up a bank of savings so that we are able, we can really aspire to be debt-free apart from the utilities and things like that. That's the reality for most people. So we actually we're then going to look at what we call good debt then, because there's a difference between good debt then and not so good debt. Because if I say, well, we think it's really important that you do aspire, and we encourage our members certainly to aspire to home ownership, to business ownership, which will mean a mortgage, then we call that good debt, necessary debt, and the other kind of debt, not so good debt. So let me just share my screen again, and let's have a look at what we are told is good debt and what is not so good debt. So here's the definition of good debt. Right. So good debt is defined as the potential to increase your net worth and enhance your life, and in an important way. So examples of good debt is, as I've said, is the mortgage. It might be fees, education, fees for education. If you are putting your children through private education, you might borrow to do that. If you need a car, if a car is essential and important to your life, it isn't for a lot of us, but for some people it is actually essential to have, and you need to borrow to purchase that car, that would be called good debt. The thing about debt though, and often some of the most important debt like a mortgage, it may well put you in a bit of a hole at the beginning. It may be a real struggle at the beginning. And I'm going to tell you a story, as I like to do, about me. When I bought my first house, I remember I didn't have any money. It was many, many, many years ago. I didn't have any money. And actually, I was living in a housing association flat and I was burgled. And I decided after this burglary that I wasn't going to stay in this flat anymore. Right? I really didn't want it. And I decided I'm not going into another housing association flat. I want to buy my own house. So I went along to my bank manager and I said to him, will you give me the money, please, for me to buy my own house? And he said to me, no. So he's not going to lend me the money to buy a house because I couldn't afford it. And I thought to myself, what do you mean I couldn't afford it? And, and he went through my stuff. And I thought to myself, you're just a racist. That's what I thought. You just don't want to lend it to me because I'm black. But actually, the fact of the matter is, I really, really couldn't afford it. I couldn't afford it. It was a real struggle. But I decided that I was going to do it anyway, even though I couldn't afford it. So for the next 3 months, I saved every single penny I had from my earnings to make up the deposit. And I bought the house. I bought my first house in Thornton Heath in Croydon. And I struggled with that mortgage. I struggled with that mortgage. For 2-3 years, it was a real struggle. But I am so glad that I did it, because I'm now in my second house, much bigger house, nearly finished this mortgage. And I'm in a way, in terms of that, increasing my net worth in a way that it would never have happened if I hadn't done it. So that's an example, I suppose, of good debt. But I was in debt for 25 years and I'm still in debt in terms of a mortgage. I've nearly finished paying off this mortgage, but I'm still paying a mortgage. But it's worth it, because the place I'm sitting in is worth much, much, much more than I paid for it. And I bought this second house, 17 years ago. So there you are. So that's good debt. That's an example of good debt. Bad debt involves borrowing money to purchase things that you don't really need, and depreciating assets, or only for the purpose of consumption. And examples of bad debt, or not so good debt, maybe I shouldn't call it bad debt, but not so good debt, are things like long-standing and building up credit card debt for rapidly depreciating items, and also things like catalogs. And I'll tell you another story about me. And when I grew up, when I was much younger, many, many, many years ago, it was really popular. Everyone had a catalogue. I don't know if any of you remember that, when your mum had a catalogue, your mum's friends had catalogues, Freeman's, I can't remember what the other ones, but they were the ones that people had. And as I was growing up, you aspired to have a catalogue. And so when I got old enough, I was steady enough, I had a catalogue, because I just liked having it. You could go in there, pick what you want, and then and spend time paying for it. And it was just a habit. There was actually no need for me to have a catalogue. And then when I become alert to things like interest rates and various other things about how other lenders consider catalogue debt, I realised that this wasn't a very good thing at all, because I was paying interest rate of 69%. That's what the catalogue interest rate was, 69%. So I stopped doing that straight away. So that's not good debt. So I'm going to say that we need to eliminate bad debt, but there are some forms of debt such as credit cards, which actually can be really good for you to have. A credit card, if you use it well, actually can provide you with access for your borrowing when you need it, if you use it properly, and can improve your credit score. The key is not to have a balance, to pay off your credit card at the end of every month or at the end of the cycle, so you don't pay interest on the debt. You get interest-free lending and you build up your credit score. But the most important thing about any form of debt that you have, but importantly, the good debt, is that you manage it and that it's controlled. When you are borrowing for productive purposes, then that spend needs to be part of a plan. It needs to be part of your overall financial plan. At the end of this series, David's going to be talking about developing the financial plan, but it's really important that your financial plan, your spending plan, focuses on why you are putting so much of your income towards certain types of debt, and what it's about. So it is actually really important to put into your financial plan it gives you a focus on what's important for you, such as house purchase. So when you're clear about why the debt is necessary, you then need to do some very important research and consideration before signing on that bottom line. And I'm just going to go through some really important things to think about when you decide that actually you do need to borrow. The first thing and the most important thing is who you are borrowing from. This is really important. Now I'm going to say something that, you know, that it just goes as read. You should never borrow from an unregulated lender or sign a contract that is unregulated. And that, when I say regulated, this means that the Financial Conduct Authority, is the government body that oversees financial dealings in this country, and registers and oversees financial providers, and they regulate them. And so if you have a reputable financial provider, they will be regulated by the Financial Conduct Authority or the FCA. So never go into debt arrangements with unregulated people. However, and of course, regulation protects you from the worst practices, because not only do they have to abide by the legislation in terms of lending and the Consumer Credit Act and various other things, but the regulator puts in other things, you know, other issues and other matters and other criteria that they have to fulfill to make sure that you as the customer and the consumer is getting a fair deal. But I just want to say one thing. Don't be fooled into thinking that because a lender is regulated, that means that they are good lenders, or they are moral, or they are kind, and they're not unscrupulous. Actually, nothing could be further from the truth. Some of the most immoral lenders actually are regulated. They don't break the law. However, I will say that many of them will break regulatory controls with impunity and will just about scrape the barrel of good practice. You really don't want to get into bed with a lender like that. So how do you know when you are what they're like? The thing to do is check out their reputation. You should do due diligence, Google checks, Trustpilot reviews on anybody that you are going to have a financial relationship with, lender. When you go and do your Google checks and you see that there are whole communities, online communities dedicated to support for victims of unscrupulous regulated lenders, that's red flag, red flag, red flag, red flags. Don't touch them with a barge pole. The real lesson is know who you're getting into bed with. The second issue, of course, is the cost of borrowing, and that's interest rates. You need to borrow at the lowest interest rate possible. Anything from between 10 to 20% is considered reasonable for consumer type lending, not mortgages, of course, which are much cheaper. But of course, what you want to do is get to the bottom end of that scale to get to borrow for as little as you can. And this is where your credit report becomes so important. The higher the risk of non-repayment, the higher the cost of borrowing. So it really isn't rocket science to know that, you know, if the lender thinks there's a risk that you won't repay the loan, or you're a greater risk of not repaying the loan for lots of reasons, and we're going to look at that in a minute, you're likely to be charged more in terms of interest rates. So the state of your credit report has everything to do with the interest rates or charges you might be offered. The next thing is borrow at the best terms possible. Now, most lenders charge fees, have fees and charges. That's in addition, of course, to the interest rates. Credit unions don't charge fees. We have no fees and no charges at PCU, but I think we're just about the only lenders who don't. Most lenders will charge additional fees for things like late payments, certainly. If you ask for things like additional copies of your statements, they might send out a statement annually. If you want one, you know, before it's due, they'll charge you for that. There's lots of things, there's a host of things that they'll charge you for. And the FCA have recently cracked down on the types of charges and the level of charges because, you know, lots of lenders were making a killing actually from charges because there were some outrageous charges. There used to be a charge if you you have a standard way of repaying the debt. So if you didn't pay by standing order, or direct debit, there were lenders who would charge you just because you didn't pay by standing order in direct debit. They're not allowed to do that now. The FCA have stopped that kind of lending, but those kinds of charges, but they are there. Now, the important thing about charges is when you're looking at the cost of your loan, you have to factor in charges with interest rates, because you might say, well, the interest rate is, oh, I don't know, 15%, but if you factor in what the charges could be, and the charges that, you know, some of them are hidden charges if you don't read the fine print, it could mean that your loan is actually costing you much more than the interest rate that you've signed up to. And this is where we come to the next bit, which is read the fine print. And this is so important to do it. And I know lots of people don't, because, you know, it's a pain really to read the fine print, but it is so important that you do. And don't think that all the fine print and all loans are the same. They are not. All lenders have different charges, say different things, have different conditions, and it's all in the fine print. And then when something happens later on with your loan and there's a problem, and they'll say to you, well, you know, you signed up for it. It was in, you know, it was in all the information that you signed. That's where you really can, where it can really become a problem. As they say, the devil is in the detail. So it's really important that you are fully aware of what you're doing. And then when you've got, finally, when you have a shortlist possibly of lenders or people that you would go to provide you with your mortgage, or other important lending that you're doing, then you should compare the market. You should then look and see what else, what other lenders are around in the same category that can give you an overall better, possibly better deal. And this is where we come to talk about the credit report, because this is really important. And I'm just going to spend a few minutes just talking about the credit report. So what is it? Some of you will know the credit report is actually a statutory instrument that contains a history of your financial dealings as they pertain to your use of credit or lending. It's a historic reference. It's about what you've done in the past. And it's kind of based on the assumption, the presumption actually, that your past behavior will determine your future behavior. And it's what you're most likely to do. Now, the thing about a credit report is you can't say to the government, I don't fancy one of those. Actually, no, I don't think I'll have one of those today. You can keep your credit reports. Actually, it doesn't work like that. As soon as you start to become responsible for a utility, for a telephone on a contract, and of course for any credit, you've got a credit report. It starts to be filled in. A file is held on you. And it's used principally by lenders or potential lenders to understand the risk that you pose in relation to the allocation of credit. But it's important to know it's not only used for that purpose. And I'll talk a little bit about that later, but it's not only lenders that will reference your credit report. And this is one of the reasons why it's so important to keep it in good stead, in good order. The information in your credit report is held by what they call a credit reference agency, and they assign a score to the information that is held. And generally, the higher the score, the better the level of risk. So there are principally 3 credit reference agencies in the UK. Experian is the largest and most used. Most lenders will deliver their information to Experian. Then Equifax is next, and finally TransUnion. It's likely that all 3 of them will have the same kind of information about you, but you might find that TransUnion, who is the smallest, might not have some information, but Experian is certainly likely to have everything about you. And the scores are allocated according to a ratio that goes from very poor to excellent. And most lenders will assign for themselves a threshold to the ratios that they will use, or for which they will say, well, we're not going to lend if this applicant is below a particular threshold. But that's not all. That's not the only thing that they look at, which is really important. The ratio is only part of the decision making. There are many other factors that they use, and each lender will use different thresholds and treats the information, certain information, differently. So why is it important to look after your credit report? So you can see that we have no control about having a report, but we can control what is in our report and the subsequent score. And so in relation to financial resilience, if you have a decent credit report, it enables you, if you need to, at any time, if you have an emergency and you need to borrow, you will be able to borrow from a reputable lender at a decent rate of interest. Now, let me just say, you know, the subprime lending market, which is lending for people with very poor credit scores, is very viable and is very vibrant. Actually, anyone can get a loan. Actually, in this country, it's not hard to get a loan. You can get a loan from anywhere because you can get one. But the problem is that if your credit report is not great, you are more susceptible to be at the hands of less reputable lenders, and certainly you will be charged very high. You can be charged very high rates of interest, and that's one reason to keep it in good order. But as I said earlier, the credit report is not only used by lenders. Other people use the credit report. It's used to verify you, because of course information is on your credit report about where you live from the electoral roll. So where you live, where you have lived, how often you move, all of those things are on your credit report. And it's also used to ascertain your credibility and your integrity. Some employers, for some roles, such as if you want to be an accountant, if you're an accountant who working in some accountancy firms, some positions in the Home Service or in the diplomatic service will look at your credit report to see if you are vulnerable to bribes, or generally to check your integrity. For some positions on some boards, you know, some institutions that have board members, as for instance, us, financial institutions certainly, and certainly us at the credit union, our directors, as part of the due diligence checks that are done before they can be appointed, a credit check is one of the checks that is done. So also the Immigration Service checks the credit report of people who are looking for long-term stay in the country. So it is really important that we understand what use is really made of that credit report. And I would just say here, before I move on, that it's really important that we ensure that our children and our grandchildren understand this and understand how important it is and how to keep their credit report in good order, because it could be the case that if they don't understand that and they find themselves wanting to go for certain types of jobs or certain types of roles, and you know, a poor credit report could impact their ability to do that. And of course, financial exclusion, and that is where you are unable to access mainstream financial services. A poor credit report is at the heart of that. So the first thing you need to do to ensure that you have to keep your credit, to protect your credit status, is first of all your history. You first of all need to ensure that you do have some data in your credit file. It's very difficult to obtain credit if there's nothing there, because lenders just won't know anything about you. Which is why there are some companies like Capital One who have products just to help you build your credit, and they will tell you how to use it. So actually you are building up your credit. Lending from the credit unions can sometimes help to build up your credit. The next thing is to ensure that you know, you are on the electoral roll, and that you can be found on the electoral roll. Next, you have to ensure that you minimize adverse entries, any adverse entries on the report. And by the same token, when you are minimizing or avoiding adverse entries, you are increasing positive entries, which will increase your score. So the kinds of things that are risky in relation to adverse entries are, as I said, your where you live. You need to be able to show that you've lived at the same address for the last 3 years. That's what lenders like to see. If you haven't lived in the same place for the last 3 years, then the address that you have before should say that you were there for at least the last 3 years. And that's because, you know, lenders, creditors get very nervous around if you seem to be a nomad, you know, you travel around a lot, you know, they might think, you know, it implies some form of instability. The next thing is your financial associations. Who are you sharing your financial, your financial details with? Who have you got joint accounts with? And it's really important, actually, I would say reduce the number of financial associations that you have, but at least when you do have them, make sure that you are financially associated with people that you really trust, and you really know what's going on. Your spouse is less risky, but business associates sometimes are very risky in relation to financial associates. They can destroy, you can find that your credit is destroyed through no fault of your own when things like this happen. Limits the number of credit accounts that you open. Each time you open an account, it lowers your score. And each time what they call a hard search is done on your account, it lowers your score. Now, hard search is one that is done to approve you for credit. Searches for identity checks and to see whether or not you're eligible for certain types of credit products are not hard searches. They call those soft searches, and they don't affect your score. If you make too many applications for credit, this will make a lender think, you know, actually, you've got a problem, there's a financial problem, and it won't help at all. You also need to ensure that you use your available credit wisely. It's actually good to have credit accounts that you don't use. This actually increases your score. So, you know, you can have that credit card, but you never use it, or you use it very little. Or when you do use it, as I said, you pay off what you spent in that month, so you don't have a balance. This is really important, and this helps with your financial resilience. Generally, you need to have about 60% or more of credit available to you. So you really shouldn't be looking to max out your cards. You know, that's not a good look, really. Also, if you have a credit balance, of course, try and pay more than the minimum amount each month. So if you do have a credit balance, don't just pay the minimum that you say, pay more than the minimum. These days, your lender will encourage you to do this because there's a new regulatory requirement around something that they call persistent debt. And what they found is when you pay the minimum and you continue to pay the minimum, you may find yourself never addressing the capital and paying far more in interest than the principal balance. And the next one is a really big one, which is pay your bills on time. Really, 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 really big one. And this is one of the biggest reasons why credit scores will fall. Missed payments. And remember I said there are some bills that we will always have. Our utility bills, your phone bills, your telephone bill, your landline, and your mobile phone on a contract. You know, if you have television services, you know, those things, they appear on your credit report. They're always on your credit report, and they appear. So you really need to make sure that you pay your bills on time. Intermittent missed payments will affect your score, and of course, potential lenders will be put off by this. Consistently missing 3 months or more will default your account by the credit reference agencies, by their books, and affect your score for up to 6 years. Other missed payments affect your score for up to 3 months. So it's important to set up those direct debits and standing orders to pay your bills so you don't forget. The worst type of entries in this category is the formal defaults, the big defaults, and that is where the company that you've borrowed from defaults the account because they may have been trying to contact you or make arrangements with you for 6 months or more, and it hasn't worked, and they just decide to default the account, and they may even try to sell on the loan. That's bad news for your credit report. County court judgments, CCJs, IVAs, and bankruptcies. These stay on your file for 6 years, whether you satisfy them or not. Satisfy them means pay it off. Now, you might think, well, if this is going to stay on my credit report for 6 years, I've defaulted or got a CCJ, and it's going to stay in my account for my file for 6 years anyway. Why should I bother to pay it off if they're not going to chase me? Well, actually, that's not the thing to do. Actually, you really need to try and satisfy that debt. And the reason why you should do that is because although it is going to stay on your report for 6 years, some lenders, in fact, increasingly there are lenders, will view the fact that you've paid off the debt sympathetically, especially if it also it's accompanied by something that's called a notice of correction on your file. Now, a notice of correction is something that you can, when you check your credit file, and I'll talk about that a bit later, you can actually, if you see that if there's a problem, you've had a problem and there's a reason why you've got into problems with particular loans, you can actually write something for lenders to see that appears on your file, which is called a notice of correction. And the lenders will look at the notice of correction if they see it before making a final decision. So there are lenders who will, and we at the PCU, we actually, if you pay off, if you satisfy a CCJ that might be there for 6 years, we will look at that sympathetically. And there are other lenders that will do that too. But there are some markers that are especially detrimental and that you really want to avoid altogether. And the first one is what they call GAIN. It's the Gone Away Information Network, and another one which is Cfas. These markers are really bad for your report. The Cfas is a fraud indicator. It's a fraud alert, and there are 2 types of Cfas markers. One is to alert the lender. The first one is to alert the lender to the fact that you may have been a victim of fraud, such as identity theft. So they need to be especially careful when making decisions. This will protect you. This is not particularly bad for you. This will actually protect you so that if someone has been trying to use your information to get credit, or there's been some other kind of fraud, which these days there often is, perpetrated on your accounts, that will protect you. But the other Cfas marker that is really damaging is where the banks or one of your lenders has suspected that you have been involved in a fraud. And the thing is, they don't have to tell you this. So you can have a Cfas mark to say you've been involved in fraud, or they think you have suspected of being involved in fraud, that goes on your credit report. That is especially damaging and will destroy your credit rating for at least 6 years. The Gone Away Information Network goes onto your file, or goes onto a file when someone has run away, not paid a lender, not paid the debt, and just disappeared. And the lender hasn't been able to chase them or find them. So what they do is they mark up the credit report, the credit file, with this gain. Again, no one's going to lend to you. I mean, absolutely no one's going to lend to you if there is a gain on your credit report, or if there's a fraud Cfas. Which brings me to my final point. Periodically check your credit file. It's really important that you do check it. You want to know what information is being used to make decisions about you. Remember, you can't control whether you have the file, but you can control what's in it. And if you check it and you find that there is incorrect information, you can challenge it and you can change it. So it's really important to do that. It's free to get your credit score, but you may have to pay for the credit report. Different companies have different charges, but generally it'll be £2 each time you ask for a credit report. Experian and other companies offer more comprehensive services where they will, look out for possible fraud on your account and see whether or not your details appear on the dark web, all that kind of thing. They charge $14.99 for that kind of thing. So the credit report is a historic record, but you can do much to improve the real-time aspects of the report. The credit score fluctuates. It goes up and down all the time. So don't worry about that. You take out an account, it goes up. You do something else, it'll go down, various things like that. The important thing is that you keep it within this kind of fair to excellent bracket. But the most important thing is to remember that you are more than your credit report. So thank you very much for that. Please write down any of your questions in the chat. What we're going to do now, Shane and I, we're going to have a discussion really about that. And we're going to ask you really to engage with us in this discussion about debt and the credit report. I'm going to pose some questions to Shane. Shane's going to pose some questions to me. But what we'd really like you to do is to also put your questions and your comments in the chat. Marcia's going to be looking at those, and we will answer those as we move on. So Shane, it's over to you.
Okay then. First question then. Are there certain types of lender that may appear on your credit report that could have an adverse impact when other lenders are making decisions about whether or not to lend to you?
Right, so I'll just paraphrase that. I think it's really whether or not there are some lenders that you want to steer away from all the time if you can, because it's, lenders sometimes look at who you've been borrowing from to try and get a picture of who you are. And yes, there absolutely are. There are some lenders that do not, if you are using them, if you go to them, it won't be great on your credit report. It's not, some of them aren't totally detrimental, but you could do with not having them, such as the catalogues that I was telling you about. Catalogues aren't great to have because they're very, very high interest rates. So those kinds of things are not great. But I think probably the lenders that you really want to steer away from are payday lenders. They're the ones that create the most problem for you. And I just want you to think about this for a moment. And I'd be really interested if you could just put your answer to this in the chat. I'm going to ask you a question. I'm going to say to you, pose to you, a payday, if you have a payday lender, if you go for a mortgage, if you apply for a mortgage and or your children apply for a mortgage, if a payday lender appears on your credit report, whether or not you've paid regularly and properly, you could have had a very good account with a payday lender, but it's just a payday lender, it is very unlikely that you will get a mortgage. Why would that be the case? Can you put that in the chat? Why do you think that's the case? If a payday lender appears on your credit report, you won't get a mortgage. I can't see the chat. Marcia, can you help me with the responses? Because I can't see the chat actually on here.
I don't think anybody knows the answer because there's no response.
There's no response. Right, okay, so I'll tell you then.
Here's some, because a payday lender is it's gone up too quick, is like an unarranged loan. Payday loan would suggest that this is Marcia B saying, payday loan would suggest that you are not very good at managing your finances, that you live beyond your means. Somebody else has said it suggests you can't manage your money month to month.
Yes.
Someone else has written that you're seen as a greater risk.
Yeah.
Denise Mead, so I'm not saying all the names, forgive me, suggests that it might suggest instability. Kyan Lindo says it's high risks. Mara V says they are sharks, aren't they? And other comments are, it might be considered you don't have enough disposable income, they're not regulated, because you won't have any money left from your salary, and it shows that your salary is not enough, that you are struggling. Sorry, about 12 of you responded. So
wonderful. Thank you very much for engaging with me on that one. Yeah, you know, all of those things. But the main thing is, I'll just say, actually, payday lenders are regulated. Do you remember I said earlier that there are some very unscrupulous lenders that are regulated, and payday lenders are regulated, actually. But the reason why, the main reason why you wouldn't get a loan is exactly what some of you said. If you need to lend from one payday to the next, because that's what a payday loan means, how can you pay your mortgage? How can they expect you to pay your mortgage? That's really the reason. So that's it. It's payday lending is especially risky. And so that is one lender that you should absolutely steer away from. Are there any other questions around different types of lenders from anyone in the chat? No? Should we move on then, Shane?
Okay then, second question. What should you do when you realise that you may not be able to cover your payments, possibly because of illness or unemployment? What are the key things that you should do and why?
Yeah, this is really, really important, actually, and I can't stress this enough. The moment you are aware that maybe you're going to be unemployed, or you become unemployed, or that you become ill and you're likely to have a long-term illness, what you really need to do straight away is to let your lender know. I can't stress how important that is. People sometimes get a bit nervous because they think that lenders are going to get arsy or whatever about it. No, they won't. Actually, they are in it. We are tied to regulatory behaviours around regulation. There's something called treating customers fairly, and every single one of us as lenders have something that we have to do, have things that we have to do before we get anywhere near getting legal or getting really tough with you. The first thing that your lenders are going to do is work with you on it. So what you do is you call your lender straight away and you say to your lender, I'm really going to have problems. I'm about to become unemployed. What are my options? But it'd be really important that actually you think about what your options might be, and you think about how you might want to handle it. And that's really good, because one of the most important things about this when it happens is that you stay in control. You know, you don't hand over control to the lender. You don't want to be in that position. You stay in control all the time. It has so much to do with how you feel about this, you know, temporary position that you're in terms of not being able to manage your loan. And, you know, lenders are really great about it. You know, you come to an arrangement, and many lenders these days will say to you, well, if you stick to this arrangement, we won't mark up your credit report. So they won't mark up your credit report as unpaid, provided you stick to an arrangement that you've made. That means if you come to a point in an arrangement and you think, gosh, this is going to be difficult, I don't think I can stick to that. Again, get in touch with your lender and let your lender know. Keep them informed all the way. And, you know, they're there really to work it out with you. If you think about it, if somebody lends you money over 25 years, like a mortgage, you know, actually the lender knows really that over that 25 years, something's likely to happen. You know, 25 years, you can become ill, you can become unemployed, lots and lots and lots of things can happen. They are really there to assist. So yeah, let your lender know straight away. Are there any questions around this, Marcy? Because I can't see the chat.
Right, there's a question here from Paulette Barnett Miller, which says, how long before a company writes off a loan that has been sold on, where you are paying an agreed amount with the new company?
What is this? Are you talking about when the loan is defaulted and they sell it on?
Sorry, Paulette, do you want to unmute?
Yes, sure. Thank you very much for that. No, there was no default. Very quickly, credit card, I had to pay my sister's funeral, huge amounts, and was paying, but the interest rate was so high that it was like I was treading water. So it was £100 a month, but the interest was £100 a month. Got in touch with the company, said, look, this is ridiculous. It's unsustainable. I'm not going anywhere, and I can't afford to pay any more than that. Long story short, we had an arrangement, and then I think the company changed, and the debt, I suddenly received a letter from somebody to say, oh, your debt has been passed on to us and we'd like to enter into an arrangement with you. This has been going on for some years now, though, where I've been paying off. And my credit score is actually excellent, but I've been paying off the amount and I've never defaulted. But I just wondered, because somebody said that after a certain time, they actually, what's the word, write off the debts. And I just wondered, is that true? And if so, how long? It would be great to lose this.
Well, you know, I'm going to ask Shane to come in after this, because my understanding is they will write off the debt if they don't think they're going to get it. If they think there's a problem with the loan and they're not going to get the loan, they will write off the debt. But often when they write off the debt, it means that there's a problem, so it will affect your credit report. I don't know of any company writing off the debt when actually you're paying it, because it wouldn't be in their interest to write off the debt if actually you're paying the debt. But they will write off the debt sometimes if there's real problems with it, but it is likely to impact your credit score. Shane, do you have any comment on that? Because you know about these things.
Well, I think it's important to make a distinction between a debt being sold off and a debt being written off. So a company can decide to sell off a debt if it decides that it is financially more viable for it, in order to get part payment for the debt, and another company then come along and then pursue the debtor for it. So you often find situations whereby a finance house will sell off a debt to a debt collector or debt collection agency who have the in-house skills, if you like, in order to better pursue that person for the debt. And that's normally in circumstances where if the person has gone away, or if the person is experiencing financial difficulties. A debt being written off only happens when a finance house decides that the loan or debt is irrecoverable. So different financial institutions have different rules which it will have to meet before it decides to write off a debt. And when it writes off a debt, it will normally have a provision or a bit of money spare put to one side to cover loans or debts that are bad or might turn bad. And in those circumstances, the loan will always be defaulted on the person's credit file. And even when a loan is written off, it's also important to remember that the company has the discretion to come back at a later date to pursue you for that debt. So although it's used its provision and written the loan off, it's still outstanding as far as you're concerned. And they might wait until your circumstances improve in order to pursue you later on.
That's really helpful. And if I died, would that debt be a part of my estate?
Yes, the company could seek to recover part of that loan from the executors of your estate. But that will often depend on how much equity there is in the estate. So if you die and there isn't enough money to cover all of your creditors, then the loan would be written off.
Paulette, can I just ask, are you a member of the PCU, the credit union?
Yeah. Yes, and I have savings with you.
Yes, why don't you just, maybe this is a conversation afterwards, but you know, the thing to do, if you're paying a lot of interest on it,
I'm not paying any interest at all.
Right, okay.
And I like my savings with you.
Thank you.
And I've been consistent with my payments for years, so I just don't want to rock the boat, but I was curious because somebody said, and I didn't know how accurate that was. Thank you, though. That was very helpful.
Good. Are there any more questions? Because we've just got 2 more questions to ask, and we've only got a few more minutes, and I really want to ask Shane. Are there any more questions in the chat, Marcia?
No more questions.
Right, lovely. So these, I've got actually a couple of questions for Shane. Shane, can you tell me, how does PCU handle the credit report when making decisions about lending?
Okay, so the credit union use a person's credit report alongside information about a person's income. So when we receive a loan application, we'll do 2 things. First of all, we'll decide, can the applicant actually afford the loan to make the loan repayment? And secondly, we then use the credit report. And the credit report, in effect, is a risk assessment. And it basically tells us what is the risk of the person defaulting on a loan. How safe is it to lend them? So the credit report tells us a number of things. It tells us how many outstanding credit items that the person has currently. How are they servicing those credit commitments? Are they on time with servicing those credit commitments? And then we may also look at things like, is the person overcommitted? So the person may actually be servicing all of their credit commitments actually and doing very well, and they've got a great credit score. But then we see a loan application come into us, and then we may then decide that actually, although the person's very good at repaying and meeting their credit commitments, this latest loan application might actually push them over the edge. And often, sometimes it's just only takes one new credit item to overcommit somebody. So we have to be careful about that. I think it's also important to remember that a credit report tells a lender a number of different things about an applicant. So, there's information about a person being on the electoral register. So it tells them about whether the person's on the electoral register. It also tells them about how often the person is moving. So every time you move house and the last, 3 or 4 addresses that you've lived in, it often will tell the lender, is that person actually settled? So it tells them a little bit about your lifestyle. The credit report also tells them about the types of products and services that you're using. Tell them about the types of loans that you've been applying for. And of course, it also tells them about how many applications you've made for insurance, loans, and other products, in the last 12 months. So your credit report, is important in the sense that it tells somebody about how reliable you are, but it also tells them about your lifestyle.
Can I just ask Shane, lots of the banks have, they automate their credit decisions. It just, the machine makes the decision. What do you do at PCU? How does it work at PCU?
So in many respects, we are the same in the sense that we have automated lending decision tools that tell us, once we input the information, the person's data into the system, it will spit out an automated decision. And that decision will be based on the person's affordability. Do they have enough spare income that will cover the loan repayments that the person wishes to take? It will also take into account the number of defaults or county court judgments the person has. And different financial institutions, their software has different thresholds which would spit out a decline. So for example, if you have a CCJ for more than £500 within the last 2 years, that will precipitate a decline in a loan for most financial institutions. If you have a default which is not being serviced within the last 6 months, that may spit out a decline decision. So the software does a number of different things. So when we get a loan decision, which is a decline, unlike a bank which may actually not engage in a dialogue with the applicant about why the loan has been declined, we will normally enter into a dialogue with the customer and give them the opportunity to put some narrative behind the reason why they got themselves into some financial difficulty. What we may also do is look at the credit report over a period of time, because what the credit report will also do, each month, each credit company feeds into the credit reference agencies, and there is a running balance over a period of time. So if the credit report 3 months ago, for example, said that you had a loan of £100 and then 3 months later it's £75, that tells us that you are servicing that default or that credit item. If we come back after 3 months and it's the same, that tells us then that you're not doing very much in relation to that credit item. So what we do at the credit union then is to look at the finer detail really behind a person's poor credit, if it's applicable. And then what we can then do is do a number of things. We can either A, award the loan in spite of the information that we see in front of us, or B, we can decline the loan outright, or we can invite the person to reapply in a few months' time once we've managed to monitor their behavior over a short period of time. And lastly, what we can also do often is make the applicant a loan offer. So if they've applied for £5,000 and for whatever reason, either due to affordability or credit issues, we might make them an offer, say, of 2,500. And we may say, take the 2.5, see how you go with that for 6 to 12 months. And if you do well with those repayments, then we can look at making up the difference.
Thank you very much. Thank you very much, Shane. Marcia, are there any questions in the chat?
I just sent you a message of a problem. It's a bit too long to read out, so I think, have you seen it? It's a direct message. I can read it out.
Yeah, if it's okay. Yeah, it's anonymous. Yeah.
Somebody entered into an agreement with a bailiff to pay £15.90 per month, and they've been doing so since 2016. And they rang to inquire about the balance as they want to clear it. However, on speaking with them, they were told that the bailiffs do not have a record of payment for a whole year. But this person knows that they've paid them, as they have bank statements to confirm payment, but can't find a record of it. As this money has not been paid to their account as agreed, is this a breach of contract between them and her? And can she take action against them?
Yeah, she can certainly take action. If she has a record that she has been keeping up with her side of the bargain and she's been paying, then she can certainly take action against the bailiff. I mean, the first thing to do in the first instance is to challenge the company and to say, these are my records. I can prove that I've made payments to you. Where's the money? Where's the money gone? And it'd be interesting, actually, that I find it interesting that they're saying they haven't had anything for a year, but they're bailiffs. So if they haven't had anything for a year, why haven't they come to her for a year? That's pretty strange, really. But yes, she can take action against them. The first thing to do is to approach them, because you have evidence, and make sure you keep that evidence. If they're not playing ball, then you can do a number of things. You can go to Citizens Advice Bureau to get assistance to take action against them, or you can go to the Financial Ombudsman. There are a number of things you can do, but yes, you can definitely take action if you've been paying it and they've got they're saying they haven't received any money from you. Are there any other? I noticed I did see something in the chat about let me see. I did see something in the chat about using your credit cards. Someone said that they'd use their credit cards and become a millionaire through using their credit cards. I don't know about that. I don't know about becoming a millionaire, but certainly, as I did mention, actually, if you use your credit cards wisely, it can certainly increase and improve your credit report. And of course, if you are clever with your credit cards, you can get a series of interest-free loans. If you use it properly, you can get a series of interest-free loans. Don't know how you become a millionaire from it though, so that's very clever, but yes, you certainly can. So any other questions? We're actually over time now. If that person who asked the question wants to send me or send us an email, I'll be happy to respond. I'm going to give the details in a minute, but let's just take 1 or 2 more questions if there are before we finish.
One other that said, have you heard about the Step Change charity?
Yes, we know Step Change very well. There are a number. Step Change is a charity that helps If you are really struggling with your loans, your finances, Step Change is a debt charity that helps you with those. But there are a few. The Citizens Advice Bureau is another. CAP, somebody says CAP, yes, Christians Against Poverty, they're brilliant. They can also help. So there are a number of charities that can help you if you are struggling with a number of debts. As I said, the first thing to do when you have problems is go and see your lender anyway, talk to your lender. But if it's all very overwhelming and you really need help, yes, there are lots of people out there. And when you do see your lender, they will send you information about all of these other charities that can help.
Okay, and there's another point being made, which is it good practice to reduce the overall credit limit on your card if you are not using the full amount while trying to clear your card? For example, reducing your overall credit balance from 5,000 to 1,000. Is it better to keep the balance at 5K even if you are not using the full amount?
You're talking about keeping the limit at 5K. That's it, isn't it? Keeping the limit at 5K. Yeah, I think it is. Don't use it. As I said earlier, one of the good things that's good for your credit report is actually to have a lot of available credit to you. So it's there. It's really great to have it, but not use it. So, don't use it, but have the balance. And it's good for your credit report. And it's also good for you if you need to use it at any time. So I would say keep the limit. Keep the limit, but don't use it. That's the key. Have your credit availability, have the availability of credit, but don't use it. And I think we need to stop there, actually. It's nearly past.
Elaine?
It's been great, actually. It's been wonderful. Thank you very, very much, everyone, for engaging with us. As I said, I'm going to put up now our details. Oh dear.
Sorry, I heard somebody want to ask a question?
Okay.
Yeah, that was me, actually. Thank you. It was easier to ask than to type it, if that's okay. I looked at my Experian report, and although my credit score is 999, there are, in terms of credit cards that would be available to me, should I choose to use them, or loans, etc., that there was a limitation. And I thought, oh, that's quite interesting, that the credit score doesn't necessarily reflect on people's willingness to lend. So quick one, I don't use my credit card because I thought, well, I don't really need to. I'm disciplined in a sense, and I don't need to spend it. Does that make sense? So I decided if I need petrol, I just buy the petrol, and I've just paid everything cash, although I've got a credit card. So in order for me, should I ever in the future be in a position where I needed, an amount of credit at a good interest rate, is it a good idea then to start spending on my credit card and just clearing it each month? Would that help?
Yeah, it is a good idea to use your credit card, but clear it. Yeah. So,
Okay.
when you're buying petrol, instead of buying cash, use your credit card to buy the petrol. And when you come to your cycle to pay, just pay it off. So it's good. As I said, you're absolutely right. That's a really good point. You've got a really high credit score, but it doesn't mean that every lender is going to lend to you. Do you remember I said earlier, they all have different criteria. They all look at different things. And there may be other things on your credit report, even though you've got a great score, that may put a lender off and say, well, actually, we're not going to lend because of it. I talked about the payday loans, for instance. Having a payday loan will not decrease your credit score in that sense, but it will put those certain types of lenders off. So if you have a payday loan that you're paying very well, your score won't be bad. But when lenders look, they'll say, don't like this. Particularly, as I said, for mortgages, they won't give you mortgages. So there are lots of other considerations around it. If it's Experian are really good. I mean, I always use Experian. Actually, I have an account with Experian, and I've got an account where they you know, do other things. I pay the money, it's, you know, because I think it's really good what they offer, and I'm always looking at my credit score. And they are really good. They will talk to you if you've got any questions about it and say, why is this happening? They will be able to look at with you through your credit report and tell you. Good. So is that it? Is that all the questions? Are they all the questions, Marcia? Is that it?
Thank you.
Great. So here, this is how you get in touch with us. Those of you who don't know, we are the Pentecostal Credit Union. We are a community bank. We provide loans and deposit taking facilities. Our members own the business. That's why we're a community bank. And our loans are at the lowest point of interest. That 10 to 22%, actually, our loans start at even less than that in terms of APR, and credit unions do that. So, you know, that's the kind of service we provide. We've been in business for 41 years, and when we're one of the oldest credit unions in the country, and one of the most financially viable. This is how you get in touch with us. The telephone number is 0208 673 2542. Go and have a look at us on the website, www.pcuuk.com. We are on Instagram, we are on Facebook, we are on LinkedIn, so you can engage with us on social media, and you can email us at info@pcuuk.com. So if you have any questions and you want to continue the discussion, please feel free to send us an email. So I will say thank you very much. Again, it's been amazing. It's been wonderful. I hope you found it really useful. And goodbye until next week. Next week, David will be with us next week. Next week, we're talking about legacy planning, a really, really important subject and topic in our communities. And David will be leading the discussion next week on legacy planning. Thank you.
And Elaine, before you go, can you just squeeze in 2 more questions?
Okay, yeah, of course.
They're in the group. Somebody has said that they got rid of all their credit cards, and was that a good idea? Yeah, she's paid off their credit cards and cancelled them. Was that a good idea?
Well, I mean, you know, it wasn't a good idea. It really depends on why you did it. I mean, you're the best judge of what that was about for you. What I would say in very general terms is, as I said, it's a good idea to have the credit available, you know, and not use it. You can have your credit cards and not use them. It looks good on your credit report. Or if you use them and pay them off every month, that's great for your credit report. But there might have been a reason why you make the right decisions for you, why you might have decided not to have them at all. But actually, you know, if you look, credits. And I think this is probably the big message from this. Credit is good if you use it properly. You know, if you use it properly and you use it to your benefit and your advantage, and you are responsible and accountable, it's not necessarily a bad thing.
Okay.
And we live in a world where there's sorry,
one other question, which is, the person, I don't know if you're going to know this, but the question is, which credit card is the best? Is it the money transfer?
Listen, it really, again, what can I say? It depends on what you want, you know. The money transfers are great. You know, my children, my son, one of my sons, always uses this transfer. You know, you get 0%. You transfer, you get 0%. He does it all the time. And he's always said to me, Mum, you're 0% finance, 0%. Keep changing, doing it. And that's what he does. And he ends up paying nothing, actually, for doing it. And, you know, you have to be on it, but you can do it. It really depends on what you want, really, what you want them for. For me, when I'm looking for a credit card, I will look at a credit card at the lowest interest rates that I can get. And I have a couple of credit cards. I don't have loads and loads, but I do have a couple of credit cards, and I've been fortunate enough to have credit cards at very low rates of interest, and they're great with very reputable companies. That's what I look at. Balance transfers are great, you know, if you're going to do them, or when you can do them. So it really depends on what you want. You know, it depends on what you want. And there are new types of credit cards coming out as well that do all sorts of different things. I don't even understand all of it, but you know, it really depends on where you are and what you need, that you can find one. So it's difficult to say which is the best. You know, what I would say is avoid high interest rates, definitely. So those cards, unless you need to repair your credit or build your credit, you will find that if you need to repair your credit or build your credit, the cards that you will use to do them will have higher interest rates. They're pretty high actually, some of them, but you can probably get, they will probably be in the region of 29, between 29 and 40%, 42%. That's really high. So even then, when you're looking at them, go to the lower end where you can. But if you're repairing your credit or building your credit, you will pay more for the cost of borrowing, because the risk is greater because they don't know you.
Thank you.
Thank you. Thank you again. Gosh, thank you. Thank you, everyone. So thank you and goodbye. See you next week.